Friends, welcome to yet another video in our series Finance and Investing Tidbits. The theme of this video is our personal cash flow statement helps us to appreciate corporate cash flow statement. Now, the personal finance and corporate finance has a lot of similarity, except that a company or a corporate issues shares or equity to promoters and public and other investors. And as individuals, we are not able to do so. But apart from this fact, there are perfect parallels between our personal finance and corporate finance. And here is one great example of how our own personal cash flow statement helps us to appreciate corporate cash flow statement. Corporate cash flow statement provides us some very interesting insights, and an investor must be aware about nuances of the cash flow statement. As I'm going to discuss in this video, just three numbers help us to understand what's going on in a company and whether it is going right or it is throwing areas of concern. So welcome to this video. So first I'm going to share with you your personal cash flow statement, and I'm sure it will resonate well with you if you were to visualize your own passbook. And then we will extend that discussion to a corporate cash flow statement. Welcome again. So let's think about what happens in a typical financial year, 1st April to 31st March. And if you just have a look at our own bank statement or passbook, as it is called in India, we actually see debits and credits. Credits typically mean the money which has come to our bank account, and debits mean money which has gone out of our bank account. So if we actually see the same thing in a simple arithmetic language of plus and minus, so all credits I designate as plus and all debits as minus, then we can actually categorize the different types of debits and credits into three broad categories. And since each one of them have a possible plus and a possible minus, we will actually have 6 pieces of interesting information that can get summarized from your passbook. So suppose we were to look at the bank statement and begin with the balance at the beginning of the year. That's as on 1st of April early morning, whatever was the balance in your account, and then we plot the 3 inflows and 3 outflows, or 3 categories of inflows and 3 categories of outflows. We can then see how we can finally look at the ending balance through the prism of these inflows and outflows. As you can see on the screen, there is a plus sign and a minus sign. Plus sign stands for inflows or credits in your bank statement, and minus stands for outflows or debits in your bank statement. So let us see, where would you get inflows from? So those I'm going to plot on the left hand side. So we would get inflows from our core activity. Either it could be salary from our employment, or if you're in business, then the business profits, or what you draw from your own business activity for your personal use, or if you are a professional giving training or facilitating learning, you would get some money out of lectures. And then of course if you're a professional, you would also get professional fees. So those are your core inflows which arise out of your own personal, professional or business activities. And similarly, you also have a lot of outflows towards household expenses, and so those are primarily the debits and credits that you would see. Now here, of course, I'm leaving aside the bank or the bank account through which you operate your business. Here I'm only taking into account your inflows, the withdrawals that you do from your business. Whereas for professionals and people who offer tuitions and lectures, you may also have outflows not only towards household expenses, but partly for meeting your professional expenses as well. So that's one category of inflows and outflows that are happening. We could call them as our bread and butter cash flows, right? Then the second category of inflows that happen is out of our past investments. Either we may sell those investments, or we may earn rent out of the property that we have rented out, or we may get interest out of deposits, or we may get dividend out of the shares that you have invested in, or mutual funds that you have invested in. And similarly, you would have outflows towards purchase of new investments. It could be a car, it could be a house, it could be financial investments. So what we can see here is that while the first layer was our bread and butter activity that we do throughout the year, the second layer was our investments related activities, both sale of investments and purchase of investments. And the third category is we may take loans for buying property, or for taking or buying a car. We may take a car loan, or even personal loans. Now, some of the loans don't get routed through our bank statement. They get directly paid by the bank to the beneficiary, which could be the developer, or which could be the car dealership, as the case may be. But nonetheless, technically that's an inflow for you, though it's not getting reflected in your bank statement, because as a matter of control, banks like to disburse directly to the beneficiaries, the final beneficiaries. What I mean by beneficiaries is not the borrower, but rather the entity to whom the money is going to finally flow. They want to ensure that the end use is proper, and that's the reason why they may directly disburse the loan in favor of those entities. But nonetheless, it's indirectly your inflow, and simultaneously, even if those payments towards the house or car don't get reflected in your bank statement, in case they are directly paid by the bank to the beneficiary, nonetheless, there is an outflow which is indirectly happening, though not reflected in your bank statement. So um, that's the third category of cash flows. So new loans, as well as repayment of loans and payment of interest. So typically the EMI that gets paid back, or repayment of loan that happens, or prepayment of loan that happens, all that will get reflected here. So when we look at both these types of inflows and outflows, and again layered into three categories, we can actually then derive the balance at the end of the year. So the first category of cash flows tells us about our bread and butter activities. We can call them as our operating cash flow. The second layer can be called as the investing cash flows. And third are about our financing activity, the finance that we raise by way of loans and the repayment that we do. So we can clearly see that there are three layers: operating layer, investing layer, and financing layer, as it applies in our personal case. And these exactly are the three layers which apply to a corporate cash flow statement as well, though of course the details and scale differs. So let's now have a look at a corporate cash flow statement, and you'll be able to see perfect parallels. So corporate cash flow statement again will have balance at the beginning of the year, and then it will have pluses and minuses. And the first layer, the bread and butter layer for a business or a company, is going to be inflow from customers, the collection that the company does from customers, and outflow towards various vendors, employees, and for meeting various kinds of expenses to various service providers, and so on. So inflows from customers and outflows towards vendors is the bread and butter, or the operating cash flow that happens in the corporate world. And then the second layer, as we saw in case of a person, there is an investment layer, which is sale of investments. Sometimes companies sell off their businesses which are not a perfect fit with their own vision and strategy, or they may even sell off some of the properties and realize that money. Similarly, there could be outflow arising out of new plant being set up, or new businesses being acquired, or strategic investments being made, or even short-term financial investments being made. So just like we have at a personal level, investment cash flows, at a corporate level also, there are investment cash flows. And then finally, there are financing cash flows in a corporate where they take loans or issue shares. Now, issuing shares is something unique to companies or even cooperative entities, but that's not something which is possible for an individual. So issue of shares and new loans is another kind of cash flow, but this is financing types of cash flow. And then when you repay the loan or pay dividends to shareholders or pay interest to your lenders or even do buyback of shares, uh, which is an exact opposite of an IPO or issue of shares, you have outflows which are happening. So again, here also we see three layers: operating, investing, and financing. Now, if we can combine them, the inflow and outflow, we can actually get a net number, and we can call this as a net operating cash flow, which is the difference between the plus and the minus. So the net sign can be either plus or minus depending on which one is heavier. If the bluer line, the inflows from customers are heavier than outflows to vendors, then the net sign will be positive. Similarly, sale of investments, business and properties, and new plant, business and strategic investments. Again, if you take a net number here, it could be plus or minus. And same thing we can see in case of financing. So we can call these as net operating cash flow, net investing cash flow, and net financing cash flow. Exactly the same thing that we see in case of an individual. So just to summarize the corporate cash flow statement, we can see here on the slide that balance at the beginning of the year and balance at the end of the year can be explained by three lines: the net cash flow from operating activities, net cash flow from investing activities, and net cash flow from financing activities. So here the net signifies the difference between plus and minus, and it can be positive or negative depending on whether inflows are heavier or outflows are heavier. So let's quickly see how to interpret this, and then we will close this video. I have a more detailed set of videos and cash flow statement in my channel. They are presented differently there, and of course I have taken some examples there that you may like to explore. But here I just wanted to draw a perfect parallel between our personal cash flow statement and a corporate cash flow statement, and therefore by focusing on just three lines of data, net cash flow from operating activities and investing and financing activities, we can actually draw some very important insights about what's happening in the company. So those key dimensions are: the net operating cash flow should be strongly positive. In other words, the collection from customers should be significantly more than the uh, payments which have happened to vendors, employees, and so on. The second one is the operating cash flow should be at least the profit after tax plus depreciation plus interest expense minus interest income. Now, I'll not go into the theory part of it, but any of you who are interested in interpreting the cash flow statement should keep this in mind, that the operating cash flow should be at least equal to PAT, which is profit after tax plus depreciation, because depreciation does not involve a cash outgo. It's a non-cash expense, and therefore to that extent the profits would be would have to be added up to show the cash flow that the business would have generated. And then the interest expense is something which is reported not under operating cash flow but under financing cash flow, and therefore this has to be added back. And similarly, interest income would be reported under investing cash flow, and therefore this adjustment would be required. I don't want to get into a lot of technicalities, but those of you who are interested in interpreting it can just try this point, right? The third important point is that the investing cash flow typically would be negative, because a firm which is expanding would be always investing. It may be replacing old equipment, it may be buying new equipment, it may be expanding, setting up a new factory. So typically the investing cash flow should be a fraction of the operating cash flow. Uh, we should not be investing beyond our means, which are suggested by the operating cash flow. So if one is consistently investing beyond the operating cash flow, there will be always need for financing, and that can become challenging down the line. This is what has happened with a lot of hotel companies, which kept on investing in lands and buying properties, and they kept on taking loans on the assumption that with the growth in the Indian economy, it's going to be more and more demand for rooms and so on. But they didn't realize that technology acted as a spoil sport, because technology suddenly surfaced a lot more hotels through some of these aggregators or aggregating platforms, and they became suddenly available. So far more hotel rooms supply happened in India than they would have visualized, and that created a challenge for them. And this investing cash flows were far beyond the operating cash flows, and they were financed out of borrowings or financing cash flows, and that put them into trouble. So investing cash flows can go beyond operating cash flows in some intermittent years as an exception, but consistently investing beyond the operating cash flows is not a good sign for a company and nor for its investors. Similarly, financing cash flows should be generally negative, indicating that the outflow or return of funds to lenders by way of investors, return of funds to lenders, and return of money by way of dividend and buyback to investors. There could be exceptions. So once in a while, a company may take loans or raise equity, but it should not be a continuous phenomena where the company has to always depend on external finances, and that is not too good. So broadly, these are the things that you can keep in mind. But if you want to actually see examples, I would also provide you links to those videos, and you can have a look at them. Thank you.